Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss the tax tail and the investment dog. Charles Schwab expands into prediction markets. We'll take a look at fixed indexed annuities and venture on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are you, good sir?
Doing well. Yeah, we're kind of in the quiet summer period. You know, for some reason, things always seem a little quiet around the office. I think, people are on vacation, enjoying the nice weather and things. But, it's created a good opportunity to get caught up on some of those long-term projects. So, yeah, been nice.
Yes, sir. I can relate. All right. Well, let's dive right in. Most investors know the feeling. You bought a position years ago. It's growing significantly, and now you're sitting on a large unrealized gain, and you're not entirely sure what to do. So this is a really interesting premise as we look at the tax tail and the investment dog. Take us through this. This is really something that was relatable to me. Like, hey, I'm starting to make some good moves. Now I'm not really sure where to go from it.
Yeah, and it's related to where we are in the market cycle, right? I mean, we had a down year in 2022, but then 23 was a strong, bounce back. 24 was solid. 25 was good, and so far 26 has been good. So we've had a lot of years of growth, and I think a lot of people are finding, maybe some of those positions that they switched into in 2022 are up substantially. And if you happen to be, fortunate enough to, pick some of the winning stocks or maybe the winning sectors, or areas of the market, they could be up substantial. And as a part of that, maybe you've become a larger and larger percentage of an overall portfolio. And now people are kind of, having to weigh the benefits of diversification versus, the tax cost of liquidating those in taxable accounts.
Yeah, so let's start with what's actually happening when you hold a position to defer taxes.
Yeah, so there can be some benefits, in terms of the growth, but then of course it often comes with increased risk, right? So, if I hold a position and it's grown substantially and now it's becoming, 5, 10, 15%, maybe even 20% of my total portfolio, more and more of my long-term investment performance is going to be tied to the performance of that position, right? Because it's more concentrated. Risk management would say you go in, rebalance. No, you don't necessarily sell the whole thing, but you take some profits and, and diversify it into other areas. So that if there's a reversal in the market trend, you don't take as big of a hit on that position. But the downside is that could come with the tax cost, right? So if you have a large position and you go in and sell, let's just say the tax liability is, $100,000 in capital gains. Well, obviously then you have to start planning for that tax liability and eventually we'll need to pay it, which means that's $100,000 less in the portfolio, right? Less money that's growing with future returns. So, you lose out on the compounding of that money that, potentially maybe you could have delayed payment to the government down the road versus paying now. So that's the costly part. But of course, on the flip side, if market trends reverse or if that position, goes through a prolonged period where it doesn't do well, you could end up giving back a large portion of the gains. And there is no 100% tax rate, right? So,
Yeah.
if you lose, you're giving back 100% of it. And whereas if you sell, you might be, giving anywhere from, 15 to 25 to potentially 40%, depending on your tax bracket.
Yeah, it's really interesting. I mean, at the end of the day, like with much of this, when we get into it, it just comes down to the working the math.
Yeah, yeah. Well, that's a lot of what we do, right? Is run those tax projections and come up with real dollars, right? Because then that helps people weigh it. But I think really where it starts is when you have a position, especially if it's becoming more concentrated, is with the question of, would I buy this position today?
Hmm.
Right? I mean, I bought it some time ago. Maybe it looked attractive. Does it still look attractive today? And when you buy it, and if so, would you buy it in that quantity? Right? Would you make it that large of a percentage of your portfolio, or would you maybe have capped it at 5% and now it represents 15%? In which case, from an investment side, it might make sense to, put together a strategy to start to maybe liquidate it or liquidate it over time. Yes, it will come with a tax cost, but over the long term, kind of as the title of the article says, you don't want to let the tax ramifications negatively impact your long-term investment strategy.
Yeah, yeah, fascinating for sure. Let's see. Next, I was going to touch on when is it a time to really start to look at, that tax deferral option versus maybe, diversifying a little bit more. What are some of the quandaries that people face when they're in this position?
Yeah, I think the best times to look at it, oddly enough, are the beginning of the year and the end of the year,
Mm,
because you're playing the tax game, right? And most people are calendar year taxpayers. The beginning of the year can create an opportunity because if you have this concentrated position, you sell, you generate the potential tax liability, but you have a very long time to potentially pay it, right? And depending on the tax situation and the calculations around the possibility of an underpayment penalty or maybe the ability to avoid one, you have a couple options. One, you can reinvest the money into other investments. Let's say then that year ends up not being a great year for the market. You may be able to liquidate those investments at a loss, right? Use that loss to offset the gain that you've already triggered and shift again into different investments. So therefore reducing the tax liability. It also makes sense to take the portion that may be allocated to taxes, and invest that in something that will earn interest, right, over that time period. So if you're not going to have to pay that tax until April 15th of the following year, you could potentially earn interest on the tax dollars for, a year and a quarter, um, on money that basically is going to be allocated to the IRS anyway, but
right.
you get some additional benefit from that, which could help to somewhat offset the cost of the tax liability, that additional earnings. So the beginning of the year is a time that can make a lot of sense. And then the end of the year is always a time for looking at taxes, saying, okay, we have a pretty good idea of where things ended up this year. Do we have losses that we can harvest to offset some of these gains? Or is there some other type of strategy, maybe around other goals like charitable gifting, et cetera, that could be used to reduce the position, achieve greater diversification, but do it in a tax advantaged way.
Yeah, you lay it out here that it's important to know your risk capacity, your time horizon, and the concentrated position that you're in relative to your overall financial picture as you start kind of digging through this and formulating that strategy. Um, are there like practical tools that are used in really organizing this and taking a look at the bigger picture and the possibility, one way or other? As you stated, nothing is a 100% guarantee.
Yeah, there's a number of different tools that can be used. Like I mentioned, if it's if you have other charitable goals, that can be a great opportunity. There's different ways to offset the risk of a concentrated position using options and things that, it's kind of like a way of buying insurance against a large position going down. There's ways to borrow against a concentrated position. Something called a completions portfolio where you borrow some of the funds and use that to invest in other things so that the portfolio is more diversified. But all of these, have both pros and cons, right? And really need to be explored based on an individual specific situation and their overall financial goals beyond just investment strategy and tax minimization.
As an investor or someone that you've seen people maybe in the past, oftentimes that feeling probably around the word taxes makes people a little bit weary of making a decision around this. Is that usually where there's the most trepidation about exploring this, where people tend to kind of just sit and I'll just hold position and ride this out, not understanding? Yes, it may be a little bit more taxes here, but you're not seeing the overall big picture.
Yeah, really what it requires is finding the right balance, right? I often joke that there are some people I run into that they would pay $3 to save $1 in taxes, right? They're so tax averse, but they're not coming out ahead. They're hurting themselves in the end in terms of their overall financial performance. But yeah, they're so adverse to writing that tax check that it really dominates other financial considerations, and that can be a real negative. But on the other hand, you don't want to be too lax about taxes, right? You don't want to, be paying more than you need to while still, balancing that with other financial planning considerations. So it's really about finding that right balance for that individual.
All right. Anything else you want to add before we jump to our next topic?
Well, just to, circle back to what you said, it's, I think these discussions, really make more sense when you're using the math, right? You're using real dollars and you can, run out projections and understand those implications. So I would encourage people that have, real concentrated positions or have seen, some really big gains in some taxable accounts to, to explore that.
All right. Well, let's dive into Charles Schwab expands into prediction markets. We've discussed prediction markets, so it's really interesting that they're adding it, but a little refresh around prediction markets just to make sure that if people maybe didn't catch our conversations around it, what it is exactly.
Yeah, so we've talked about Polymarket and Kashi, right? These kind of new startups around prediction markets, where basically, people can put real money behind expected events, and based on the percentage likelihood, right? So, one I saw recently was that the Strait of Hormuz would return to normal traffic, by the end of June. Well, here we're, basically at the end of June, right? And so not a lot of time. And on Polymarket, there was a 4% probability that that would happen. So basically, if you put in 4 cents and it does happen, you'd win $1. If you put in 96 cents and it doesn't happen, you'd get a very small return, right? You'd win $1. And these prediction markets are very interesting in how they price out these different events, which in some cases can be a way for people to express their views on a certain outcome. In other ways can be an opportunity for people to hedge a certain risk, right? If you're trading in oil futures and you're looking at oil prices, well, obviously the amount of traffic through the Strait of Hormuz could impact that. Maybe you are able to hedge that position by going long oil, but if the strait were to be closed, you'd get a payment that would offset, or the strait were to open, quickly, you'd get some offset that would, reduce your losses if oil futures fell or something like that.
Yeah.
Yeah, they're a very interesting new market, and we're seeing other kind of more traditional brokerage firms, custodians like Charles Schwab, starting to kind of dabble or enter that market to some degree.
Yeah, it's really fascinating. I mean, the more we talk about it, I'm still really trying to understand it, how it would, differentiate from betting on the Yankees game tonight or something like that.
Well, in a way, yeah, it's very similar. And a lot of prediction markets do have, sports futures, they call them, or sports predictions, which, as has been shown, I mean, these are not contracts tied to underlying assets like you get with,
Hmm.
stock options or futures or that type of thing, right? It's more just, an unknown in which people are expressing a view, and the total of all of those views and the amount of money behind them determines the pricing, which is pretty interesting because it can be fairly accurate, right? A lot,
Mm-hmm.
a market where there's a lot of participants putting real money in, right? This isn't like survey data where they, can say whatever they want. They have skin in the game. It can be very useful to understand the overall market view of the likelihood of these given outcomes. So we've used it as kind of getting an indication of just where the viewpoints are at. But in terms of actually using them as an investment, there's definitely some significant risks related to that.
Yeah. Well, is there a common characteristic between the two markets? Obviously, the options market largely more established, right? But this is interesting that this market has emerged.
Yeah, again, different types of derivatives and things. I mean, the name derivative is because they derive their value from some other asset. So there's this relationship with these, historically well-established assets. In the predictions markets, that's not really the case. And so there's a lot of uncertainty. One of the challenges is we know the stock market over the long run has had an upward bias, right? We know the bond market, you're getting this yield that has typically produced a positive rate of return. As you stated, going into the prediction market and deciding whether or not the Yankees are going to win, there's not necessarily a positive bias to that, right? And even if the Yankees are better than the team that they're playing, that's priced in. So you're going against a very efficient market with a lot of, people in that market that may have more advanced knowledge. It's typically going to be difficult to win over the long run, especially when, as with any market, you have the platform taking their cut, right? And traditional sports betting, that's the casino takes their cut. So even if you get half right and half wrong, you're going to lose money. And that would also be true of these prediction markets because there's not a significant bias. So, positive bias that should produce returns over time. So you're competing with, very knowledgeable people that may have more resources. And then, of course, as we've seen in some of these prediction markets, you may even be competing with people that have inside information,
Right.
right? That's not available to you. There's been a number of scandals around that with some of these contracts moving very significantly over a short time period, and then come to find out someone who had inside information, possibly even classified information, and they're still not regulated, the way the stock market is with insider trading and things like that. So you could be, at a disadvantage in these markets for a number of different reasons.
Yeah. Anything else you want to add before we jump to fixed indexed annuities?
Well, just like anything, these prediction markets are risky. They can be a great source of information, but in terms of actually being able to profit, that is yet to be proven that people can, be consistently successful.
Yeah. All right. Fixed indexed annuities are tax deferred insurance products that can provide principal protection and potential for gains, which are tied to an underlying index. How do the gains work in a fixed indexed annuity?
Yeah, so a fixed indexed annuity is, it's kind of a hybrid and they're fairly complicated. And as with complicated financial products, usually the devil's in the details, right? And it kind of hides some of the risks or some of the negative potential outcomes. So a fixed indexed annuity is kind of a combination of a fixed annuity, which typically is where you'd loan money to an insurance company and they'd pay you an interest rate, right? Pretty simple, low risk, usually low returns. An indexed annuity is a fixed annuity where they basically take that interest and then invest in, options or futures contracts related around an index. And then with that, they create a formula that determines, how much the policy may gain if a given index does X, Y, or Z. And one of the real selling points of these is typically that if the index goes down, you don't lose. right? You don't necessarily get any return because they've used the interest that you were earning to buy these other options or futures that didn't pay off. But if the index goes up, you get to participate. But typically, your participation rate is capped, which means you're limited on how much you can gain when that index does well. But people look at that and say, okay, well, I'm willing to give up some of the upside, right, in order to limit my downside. And so it looks attractive kind of, on the surface.
Yeah. Well, it also states that fixed indexes annuities are also subject to surrender schedules. I don't remember us ever that term coming up in the 10 years that we've been doing, plus we've been doing the podcast.
Yeah, so a surrender, I mean, they have expenses, and then the surrender is if you try to get your money out, they're only going to give you a percentage of it back, or basically the insurance company is going to keep a percentage. And often, those can last up to 9 years. 7 to 9 years is pretty typical. So, part of what people are doing is giving up their liquidity, right? Their ability to access their money. And as we've discussed in the past, that's one of the big mistakes that you see the average investor make. They don't value their liquidity. And so they give it up for much lower return, additional return than they should demand, right? Because people say, oh, I have this money. Maybe it's for retirement. I don't think I'm going to need it. Okay, I don't really care that it's going to be locked up for 9 years. But things change. And the ability to change your strategy when things change is very valuable. And people are often giving that up with no additional expected rate of return. The other problem is the participation rate, the formulas that are used for the rate of return. They look good on the surface, but only if you don't really understand markets and run them against market behavior, right? There's, most of the time the market's going up. So the cap at not losing is not that valuable most of the time. And there's a lot of periods where the market's kind of stagnant to going up a little, and then periods where it goes up a lot. And that cap on how much you're able to participate in those gains can reduce the upside substantially. And because you're likely to have a lot more of those upside, periods than the fewer bigger drops that we tend to see, the lost return often is greater than the protection in the down periods, leading to rates of return that are much lower than people expect. You don't necessarily see it in the first year or the second year because it hasn't had a chance to compound. But over a 9-year time period, often people are looking at what the stock market did over that time period, right? What the index that they're participating in did, and then wondering how their return is so low comparative to that. And it's because, really the patterns of market returns, when you overlay them against these, these formulas, it shows how it really doesn't work as you would expect if you just kind of, take the summary and assume, oh yeah, this looks great.
Yeah. Anything else you want to add before we jump to the Plan Solutions Incorporated Office Bulletin Board?
Well, just that, again, these are, very complex investments. The formulas are very complex, and people really need to understand what they're getting into, because they're, the pros, the benefits are often, summarized and pushed, but not as you dig into the details. There can be significant, drawbacks.
Yeah. All right. Well, we got one item pinned up there on the bulletin board. What is it, Mr. Armour?
That's right. Yeah, not a lot to announce, but we do want to let people know that we will be closed on Friday, July 3rd for the 4th of July holiday, of course, because it falls on a weekend. So yeah, happy 250th birthday, America. It should be a fun year, and I hope everyone has an enjoyable and safe 4th of July.
Yes, sir. Well, we thank you all for listening to the Plan Solutions Incorporated podcast. Please hit that subscribe button if this is your first time listening on whatever platform you use for audio podcasts. And of course, if you would like to follow along to a video form of the podcast, please go over to our YouTube channel. That's youtube.com/@plansolutions and get subscribed there today. And if you have yet to subscribe to the Personal Financial Review, all the written content that Chase and I discuss here on the podcast, it's easy to do. Just send Katie an email. That's KATIE @plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.